Liabilities. Current liabilities are obligations that will be settled within 1 year or one operating cycle, whichever is greater. Typical liabilities, current liabilities include accounts payable, notes payable, current portion of long-term debt, any taxes that are payable, accrued liabilities, unearned revenue. And then, as we've discussed before, long-term liabilities are liabilities that are due after 1 year or after one operating cycle. Now, so owner's equity, as we've discussed before, owner's equity is simply equal to the total value of your assets minus the total value of your liabilities. So the interesting part with owner's equity is to understand the categorization or different parts of owner's equity. Contributed capital is the total amount paid in by the common and preferred shareholders. So this essentially means that if the common and preferred shareholders invested $100 million, then that is the contributed capital. This is the money that was contributed by the shareholders. Retained earnings are the cumulative earnings not yet paid out to shareholders as dividends. So let's say that this company has been in business for 5 years, and the last 5 years the company has made profits of 15 million, and from this 15 million, 5 million has been paid out as dividends. So retained earnings is 10 million in this case. Why is it 10 million? Because total earnings were 15, 5 million paid out to the shareholders. So what the company has retained is 10 million. So the retained earnings are also a part of owner's equity. You can think of it as follows, that the earnings belong to the owners of the company. If they don't take that money out in the form of dividends, they have essentially and effectively put their money back in the business, and hence retained earnings are a part of equity. Minority interest is the minority shareholders' prorated share of net assets of a subsidiary that is not wholly owned by the parent, and I will explain this in the next couple of slides. And then we have other comprehensive income, which I will also explain shortly. Owner's equity, when we talk about different kinds of shares, we need to understand this. When you see authorized shares, these are the number of shares that can be sold under a firm's article of incorporation. So when a firm is incorporated, it might say that the number of authorized shares is 10 million. So these are the total number of shares that can be sold. Issued shares are the number of shares that have actually been sold or issued. So of the 10 million, let's say that the company has actually issued 6 million. Outstanding shares are issued less number reacquired by the firm. So reacquired means when the company does something called a treasury stock operation, the company is buying back or reacquiring some shares. So let's say that the company has done a treasury stock operation for 2 million shares. Then the number of shares outstanding would be 6 million, which was the number originally issued, minus the shares reacquired through the treasury stock operation, which will give us 4 million. So this is an example of a treasury stock operation. Notice that the treasury stock operation reduces shareholder equity. So when a company issues new shares, that increases shareholder equity, because issuing new shares means that shareholders are putting more money into the company. Treasury stock operation means that the company is paying money to shareholders, so money is leaving the company, and hence that reduces equity. Minority interest represents the portion of the consolidated subsidiaries owned by others. So before talking about IFRS and US GAAP, let me just explain what this means. So say you have a large company called Engro, which has several subsidiaries, and Engro reports its consolidated balance sheet. Now, one of the companies is a subsidiary called Safa Foods, and let's say that Engro owns 80% of this company. That means that 20% is still owned by the original Safa family, or the people who started this company. So that 20% is still owned by what's called the minority owners. 80% is owned by Engro. Now, let's say that the total assets of Safa equal to 100, the total liabilities equal to 30, and the equity is equal to 70. When Safa's balance sheet is consolidated into Engro's balance sheet, the entire assets of 100 are shown as part of Engro's balance sheet, and similarly the entire liability is shown on Engro's balance sheet. So if we show net assets here of 70, which is 100 minus 30, 80% of that belongs to Engro in this consolidated balance sheet, but the remaining 20% belongs to the minority owner. So that 20% of the net value of Safa's assets is what is referred to as minority interest. This whole topic is explained in a lot of detail in level 2. So if you don't fully understand this at this stage, not a very big deal, just memorize this statement. But when we get to level 2, then there is a reading called intercorporate investments, where this is covered in a tremendous amount of detail. Now, how is this reported? Under IFRS, we should report minority interest in the equity section of the consolidated balance sheet. And the thought process is quite straightforward. The minority owners are owners, and hence their share should be classified as equity, and hence their share is shown in the equity section. US GAAP is more flexible. It essentially says that minority ownership can be shown anywhere. It could be in liabilities, it could be in equity, or in between liabilities and equity, which is called the mezzanine section. Now let's talk about other comprehensive income. You've seen this before when we did the reading on the income statement, but nevertheless, let's talk about this again. Accumulated other comprehensive income includes all changes in stockholders' equity, except for transactions recognized in the income statement and transaction with shareholders. So let us understand this through this fourth point over here. As you just saw in the financial assets segment a short while ago, if you classify a financial security as available for sale and there are unrealized gains or losses, we said that the unrealized gains or losses are shown in other comprehensive income. So take an example where on a AFS security there is a unrealized gain of 2 million. And also the AFS security on the balance sheet is shown at fair value. So let's say that you originally bought a security for 10 million. At the end of the year, the value of that security is 12 million and you have not sold it. So the gain of 2 million is unrealized. On the balance sheet, you are now showing that financial asset at fair value, which is 12 million. So on the balance sheet, our total value of our assets will show an increase of 2 million. However, this 2 million which is unrealized gain, does not show up in our retained earnings. So the retained earnings impact of this 2 million is not there because we do not show the 2 million unrealized gain on the income statement. Remember from an earlier lecture that the value that is shown for retained earnings on the balance sheet is the number that comes from the income statement. Since this 2 million was not on the income statement, it does not show up over here. So that would potentially create a mismatch between our assets and liabilities. And to avoid that mismatch, we have this category called other comprehensive income, which is also a component of equity, where we show the 2 million. So now that 2 million gain will become part of equity through this segment or through this subcategory called other comprehensive income. So the bottom line is there are certain transactions or certain items where we record numbers in other comprehensive income. The example that I hope you understand based on what we've already covered is this one, number 4. Any unrealized gains, losses from available for sale securities are shown in other comprehensive income. And then there are 3 other categories which for now you just should memorize, and you will understand these in more detail when we do this in level 2. But basically, unrealized gain, losses from cash flow hedging derivatives, adjustments to minimum pension liability, foreign currency translation gains, losses. So all these are shown under the comprehensive income. So what's the distinction between accumulated other comprehensive income and other comprehensive income? The other comprehensive income is your OCI for a given year. So in our example, let's say that this is the only other comprehensive income, that's 2 million. And then next year, let's say other comprehensive income is 3 million. Then we can say that the accumulated other comprehensive income is 5 million. Just as you have retained earnings versus accumulated retained earnings, where retained earnings are the retained earnings for a year, accumulated retained earnings means that we are simply accumulating our retained earnings and equity is going up. Similar concept applies with OCI. OCI is for a given year and accumulated other comprehensive income is simply a cumulative number since the company got started. Reporting other comprehensive income, according to US GAAP, we report other comprehensive income in the income statement below net income, or in a separate statement of comprehensive income, or in the statement of changes in shareholders' equity, which I will discuss in the next slide. According to IFRS, it is not required to report other comprehensive income. However, an analyst should be able to figure out the other comprehensive income based on the differences between equity value shown in the balance sheet versus the retained earnings that we derive from the income statement, earnings minus dividends. So let's now talk about the statement of changes in shareholders' equity. The statement of changes in shareholders' equity reflects information about the increase or decrease to a company's net assets or wealth. So there are 3 categories or 3 ways in which shareholders' equity changes. One is common stock or contributed capital. So for example, how does this change? Let's say that you have common stock at the beginning of the year worth 5 million. So that's your beginning common stock. And now if the company issues $2 million worth of additional common stock, so what will that do? If $2 million worth of additional common stock is issued, then the contributed capital increases from 5 million to 7 million. And then let's say that there's a treasury stock operation of 1 million. So this is treasury stock. And what's the ending balance then? We will end with 4 million. No, I'm sorry, 5 million plus 2, 6 million, minus 5 plus 2, 7, minus 1, 6. So we end up with 6 million common stock at the end. So this is the end common stock. Retained earnings, this refers to how much of the net income is retained. So let's say that at the start of the year, our total accumulated retained earnings, which we'll call beginning retained earnings, is let's say 1 million, and during the year the net income was also 1 million, but dividends paid out were 0.5 million. So for this year the retained earnings were 0.5 million. So the end retained earnings will be 1 million plus 1.5 million, which is, so 1 million plus 1.5, which is 1.5. So that's our ending retained earnings. And then the other comprehensive income. So other comprehensive income that we've talked about, remember this had 4 categories: unrealized gains from for available for sale, cash flow hedging, minimum pension liability, and foreign currency translation. So again, I'd just say that you memorize these 4 items as being part of other comprehensive income. So with other comprehensive income, say your beginning balance was 2 million, and then you look at the impact from each of these 4 categories. Let's say that from AFS you had other comprehensive income going up by 1 million, and let's say that for now there is no impact from these 3 other categories, then your ending comprehensive income would be 3 million. So these 3 items, the common stock, retained earnings, and other comprehensive income, these are what impact the shareholder equity. So in our case, in this simple example, the equity at the end of the year would be 6 plus 1.5, which is 7.5 plus 3. So we end up with equity of 10.5 million at the end of the year. What was our beginning equity? It was 5 plus 1, 6 plus 2, 8. So we started with 8 million. From 8 million we went to 10 million, and basically the statement of shareholders' equity explains how that change of 2.5 million happened. Now we'll talk about some analysis related tools. The most important, or at least from this reading's perspective, the significant one is the common sized balance sheet. So a common sized balance sheet expresses each account as a percentage of total assets. This format is known as a vertical common sized analysis, allows an analyst to carry out time series analysis and cross-sectional analysis. So this is fairly straightforward material. If you have a company with total assets equal to 100 million, so total assets equal to 100 million, then every single item on the balance sheet is shown as a percentage of 100 million. So if your cash is equal to 2 million, then cash will be shown as 2% of 100, and so on. Now this allows an analyst to carry out time series. So this basically means that time series analysis means analysis over a period of time. So if you want to see, for example, how inventory has changed as a percentage of total assets over the last 5 years, looking at the common sized balance sheet will allow you to do that. Simply looking at inventory values might not tell you the full picture, because the company might have grown. So if the company is growing, clearly inventory is going up. But what we are interested in is whether we are carrying more inventory relative to our overall assets. So it might be that inventory is going up in absolute terms, but as a percentage of total assets, it is possible that inventory is going down, which means that we are becoming more efficient. So when we do an analysis over a period of time, That's called time series analysis. Cross-sectional analysis would be where you are comparing different companies at the same point in time. So for the year 2010, you can look at how efficient companies A, B and C are in terms of using their inventory, and you can simply then look at the common sized balance sheets for the three companies for this year. Some basic ratios which you need to be very familiar with. Liquidity ratios measure the firm's ability to satisfy short-term obligations, and solvency ratios measure the firm's ability to satisfy long-term obligations. Specifically, you need to know these liquidity ratios very well. The current ratio is probably the best and most commonly used measure of liquidity. It is simply current assets divided by current liabilities. Current ratio less than 1 points to possible liquidity issues. A quick ratio is more conservative than the current ratio. Here we simply take cash, marketable securities and receivables. So we do not include inventory over here. Sometimes this numerator might be shown as current assets minus inventory. So you might have seen this in some other textbooks. So assuming that other current assets are not significant, then what you see over here and what you see over here would approximately be the same. Here the assumption is that inventory is not very liquid, so we want to see what our ratio is when we remove inventory. Cash ratio is the most conservative. This simply says that even accounts receivable might not be very liquid, and hence we want to simply take cash and marketable securities and divide by current liabilities. The higher the liquidity ratio, the more likely that a firm will be able to pay its short-term liabilities or obligations when they are due. Solvency ratios are more long-term. So long-term debt to equity ratio is 1. This measures long-term financing sources relative to equity base, and the ratio is long-term debt to equity is equal to total long-term debt divided by total equity. The debt to equity ratio measures total debt relative to the equity base. So this will be debt to equity is total debt divided by total equity. The total debt ratio measures the extent to which assets are financed by the creditors. So this would be total debt over total assets, and the leverage ratio is a variation of the debt to equity ratio, and it is used in the DuPont model that we will see later, and this leverage ratio is total assets divided by total equity. The usefulness and limitations of ratios. So ratios give you insights into financial relationships. As mentioned earlier, if you want to see whether inventory is going up or down, simply looking at inventory numbers is not as useful as looking at inventory relative to total assets. It gives you information on financial flexibility. Companies that have, for example, very low debt to asset ratios will have more flexibility than companies which have high debt to asset ratios. Measures, means of evaluating management performance. So depending on what you want to measure, ratios allow you to evaluate how management is doing. So back to this inventory example, if you are evaluating the inventory the inventory function or the inventory control function, you would, rather than looking at absolute values for inventory, you would want to look at inventory relative to total assets. Limitations. Ratios cannot be viewed in isolation. So you can't simply say that for a given company the inventory to total asset ratio is 10%. Is this good or not? In isolation you can't tell. What you need to do is compare with other companies in order to determine whether this is good or not. Specifically or ideally you control with the best in class. So that process is called benchmarking, where you compare your company with the best companies in the industry to determine whether your company is doing well or not. Other limitations. So when you do compare, the comparison with other companies are made more difficult because of accounting methods. So if different companies account for inventory in different ways, then you need to make certain adjustments before you can use these ratios. Sometimes it's difficult to locate comparable companies. So you might be in a business where it's not easy to find comparables. So that makes the use of ratios difficult. Conclusion cannot be without viewing a relative set of ratios over time. So that's obvious. And clearly with ratios, a lot of judgment is required. Despite these limitations, ratios are used extensively in financial analysis. So it's a good tool and you use it as long as you understand what the limitations are and how to address those limitations.